Hello and welcome to the Investing on the Go podcast, brought to you by FundCalibre. I'm Darius McDermott, and this evening we're joined by Job Curtis, who is the manager of the City of London Investment Trust, which is elite rated by FundCalibre. Job, good evening, and thank you for coming and attending our special investment trust event.
It's a pleasure. Good evening.
So look, we live in interesting times,
Yes.
and we are pre-election when this podcast is recorded. Do you have any views on the election and outcome for stock market, or do you think it will carry on?
Well, the UK stock market is predominantly in global companies which are listed in the UK, maybe headquartered in the UK, but with a global reach. So, it's of limited relevance to them, but obviously there's some 30% of the markets in domestic stocks, and it will be more relevant for the domestic stocks. I mean, looking at the possible outcomes, I think it has to be said a majority Labour government under Jeremy Corbyn would be a negative for the stock market. Certain sectors like utilities, where Labour's planning to nationalise
infrastructure, utilities,
absolutely. But
challenged.
I think most other outcomes, the stock market, there's so many different permutations, but the main two outcomes being a Conservative majority or some form of hung parliament. It's a longer subject, but I think now both of those outcomes wouldn't be bad for the stock market. In fact, there could be some quite positive implications for both in different ways for those two outcomes.
Yeah, and I suppose it's that dual-purpose UK market. We've got your UK domestic, and you've got your overseas earners, which are big parts of the FTSE 100.
Yes.
But just sticking with politics, and apart from our own fine election, we have a potential Brexit. Now, I appreciate a Brexit outcome is predicated on who wins that election.
Yes.
But there's several outcomes. Have you any position you can take? Obviously, currency is a moving part of the Brexit outcome, as we watch on a daily basis.
You're right. The pound tends to go up when some sort of deal in terms of Brexit is likely, and then the converse when deal looks unlikely. But I think if Brexit is resolved, I think that would be good for the market overall, because I think it's been a pall of uncertainty over the market, and I think the market craves a bit more certainty, both for business investment and also for fund managers globally. The UK has been very out of favour in the UK stock market, I think slightly irrationally, but I think they will gain a bit more confidence. Having said that, the withdrawal agreement being passed is only the first stage, then we have to negotiate some sort of trade deal
thereafter.
So I think it's only the beginning of a process, but it will be an important staging post if it does get achieved. Or, the alternative route, which is less likely but possible, we go back and have another referendum, and there's that whole implication. But I think the stalemate we've had hasn't been particularly helpful. I
think that's the key thing, isn't it? It's the market uncertainty, the stalemate. Nobody knows which way we're going.
Absolutely.
I think with some certainty of left or right, and I don't mean left is out and right is in, or vice versa. But it would be nice to have some clarity for stock pickers like yourself.
Absolutely.
Now, obviously, you're a UK equity income manager. What's your sort of longer-term view for the UK stock market? How do you feel we look today, given the uncertain backdrop we've come from?
Well, I think there's some great value on offer. In particular, the stock market yields slightly over 4%. That means the dividend yield is over 4%. So when you compare, with interest rates are still incredibly low in the UK, only 0.75, banking the base rate, what you get in a cash ISA or what you get in fixed interest, I think the dividend yield's attractive. And we've got some great companies, we've got some real global leaders. And I think, if some of those domestic issues, a bit more uncertainty on the domestic economy, then you could see a sort of strong bounce in some of the domestic stocks within the UK stock market. So I'm pretty positive going forward, actually.
And do you think that sort of domestic stock market might be a shorter term bounce? Some of those sort of unloved UK domestic names, do you have many of those?
Yeah, I have got some. We we're predominantly in the large multinational type companies, but the UK banks, I think, are in a much better state than they were, than they were going back. And stocks like Lloyd's do respond very well on days when there's kind of more optimism on the kind of political uncertainties. And the house builders is another sector I favour, and I've got some decent positions in stocks like Taylor Wimpey. There are other areas which are structurally challenged, like retailing, where it's not just about the domestic.
Yeah, it's not whether you're doing it. Yeah. It was incredible, wasn't it? I think it was the 11th of October when there appeared there might be an outcome between the UK and the Irish government about the backstop.
Yes.
You'll remember it, I'm sure, because Royal Bank was up 13%,
Yes.
Lloyds was up 10%,
Yes.
and it was a real, the domestic side of the market going, and it was a sort of little reminder, I think, to all of us that that part of the market still exists.
Absolutely. It really illustrated the potential in that part of the market, and that there will be further gains to be made if we do get more resolution.
Yeah. So look, I think something which I know you're extraordinarily proud of, but actually the dividend increased on the trust itself. You are, I know, in the list of dividend champions at the AIC, which is the Association for Investment Companies. You've managed to increase, not necessarily just you, I might add, Joe, for 53 years. Tell our listeners about how that happens and when from time to time you need to use reserves, something that the investment trust structure allows that the open-ended doesn't.
Absolutely, it's a very important point. I mean, we have at the core of our portfolio quality companies that are able to consistently grow their dividends, but in difficult markets you do get dividend cuts, and it's inevitable then that the earnings for the fund might dip, and that has occurred. I've managed the fund 28 years, and in 7 of the 28 years we've had to dip into the revenue reserve. And how this works is that in the good years, as an investment trust, we can hold back a little bit of the income up to 15%. We might hold back, say, 5-6%, put that in our revenue reserve. And then in the difficult years, those 7 difficult years during my period for income, we can dip into that reserve. So for consistent dividend growth, 53 years is the longest record of any investment trust or fund in the UK,
really,
and it is, and we're very proud of it. In fact, we could only have achieved that through the investment trust structure, but having that revenue reserve, which currently is about 83% of the annual cost of dividends. So,
so if you had no income at all, you could almost cover next year's dividend.
I mean, we'll
I know it'll never be that extreme,
but it certainly tied us over for a few years. I'm sure there'll be periods going in the future when we will need it again. And it's inevitable the way the business cycle and stock market cycle goes.
Of course. Now, another key differentiator between open and closed-ended income funds, or in fact any closed and open-ended fund, is the ability of the investment trust to actually borrow money, which is called gearing.
Yes.
Are you structurally geared? Are you permanently geared? Or do you use it when really ripe, juicy opportunities come along? And where are you today?
Well, we run the trust in a fairly conservative manner, but a small amount of gearing will help in a rising market, will enhance the asset value. And we have got some fixed rate borrowings. We've got one borrowing going out to 2049. We're paying an interest rate of 2.94%. We're pretty confident that our portfolio will beat that return per annum over that period. So our gearing on our fixed rate borrowings in total is around 8% currently. But in addition, and that's strategic, we can negate that effect of gearing through derivatives if we want to. But basically, that is long-term strategic borrowing. And then we have the ability to borrow short-term through a bank facility of about £120 million, which we pay a very low rate of interest on. At the moment, that's largely unutilised, and that's
when's the last time? So what you described initially was sort of a structural gearing at around that 8% level. But when was the last time you tactically were so enamoured of the UK market, or your opportunity set, you thought, I want to just dial it up a little, whilst appreciating that this is, of course, a conservative trust?
Yes. Well, in general, when the market's in its weak periods, we tend to use more gearing, and it really comes back to sort of buy low, sell high approach. And often in the weaker periods of the market, there may be issues around, but there's greater value in terms of stock prices. So, going back, we've had, the highest gearing we had was in 2003, at the bottom of that bear market, as we
post
call
the TNT bubble.
Exactly, and we got up to about 17% gearing. That's the maximum we've been in my 28 years. We say we won't go any higher than 20%, be the absolute maximum, but typically the range is kind of 6 to 12% would be more typical of our range normally.
And with your investment trust structure, another differentiator to open end is the fact that you have an independent board to liaise with, to give oversight, and I know you have regular meetings. Could you give us just a little soundbite or an overview of some of the sort of discussions you have with the board, and whether they challenge you on something or whether they support you? Or how does that work?
I mean, it's such a good point you make, because it's a very important advantage of investment trusts. It's an independent board of directors gives you an extra layer of oversight. We have 8 formal board meetings a year, and then in addition...
That's quite a few then, actually.
Yes, and I speak to the chairman on the phone every 2 weeks or so, and they really question the overall strategy. They're not trying to second guess you on your stock picking, but the overall strategy. Like, for example, the gearing we've just been talking about, something you would discuss with them, and your overall allocation between different sectors, etc. And they monitor how the revenue. We have each board meeting we update them on how the revenue for the year is going. So it's an incredibly valuable part of the investment trust structure, and I think a great advantage for the investors.
Do you ever have pushback from the board? Has there been an occasion where you thought, oh, they're really disagreeing, whether it be about gearing or, occasionally you might want to, do you ever buy an overseas company or anything?
Yes, we got about 10% in overseas listed, which has been a successful part. We'd never go higher than 20%, but no, the board do challenge me, and I think that's really healthy. I mean, I think it's really, I get challenged in the office by colleagues, and I really enjoy it. I don't like working from home. I like going into the office, and I've never worked from home really. And the board has similarly challenged me, and that's, as a fund manager, it's incredibly important. You've got to have people putting the other point of view to you, and so you can see the angles you might have missed.
Job, thank you very much. I'm Darius McDermott, and if you'd like more information on the elite-rated City of London Investment Trust, or more information on the Investing on the Go podcast, please subscribe to FundCalibre.com. Please remember, we've been discussing individual stocks to bring investing to life for you. It is not a recommendation to buy or sell. The fund may or may not still hold these stocks at the time of listening.